everybody. My name is Adrian Fuchs. I'm working for the Financing Agency for Social Entrepreneurship, and happy to have you here today as we have Mark Cheng joining us. He's in Hong Kong at the moment, stuck with Corona, and couldn't come back to Europe. So he's joining us from Hong Kong today. Thanks for that already in the beginning. Maybe I spend one or two sentences on myself. I'm working in Germany for the Financing Agency for Social Entrepreneurship. We are part of Ashoka Germany, so we kind of belong to this Ashoka universe, but we are focused more on really impact finance, meaning that we consult social enterprises on how to find investors, how to approach them, and also in the end kind of moderate this whole transaction process. So our offer to social enterprises is kind of that we say from the beginning, from the first investor approach till the end, till the money's on your bank account, we are by your side. That's kind of our value add. And now I already want to hand over to Mark. We're gonna share his experience on impact finance and also how to approach investors. And I think maybe in the end I also can add some value, and then after like half an hour we can make it interactive. So please feel free to pop your questions. We're just gonna collect the questions in the chat, or you can just write them to me directly, however you want it, and then we can go and make it interactive in the second part.
Okay, great. Adrian, thank you so much, and hello everyone, and thank you so much for joining this webinar. So as Adrian mentioned, my name's Mark Cheng. I'm the Social Finance Director at Ashoka, which is a partner to the program, and which is we're a global network for social entrepreneurs around the world. So we work with about 3,000, just over 3,500 different types of social sector organizations in about 90 countries around the world, and Eastern Europe is a very, very big part of that as well. So we have many different types of social entrepreneurs that we work with, and my role at Ashoka is on the finance program. So we work with a lot of the enterprises that are looking to raise capital, and a few years ago we actually surveyed all of our Ashoka fellows, as they're called, the different founders of these organizations. And we asked them, what is the biggest barrier that you face to scaling up? And you won't be surprised to hear what the #1 answer was that came back from everybody universally, was access to finance, right? It was how do you tell your story in a way that is going to be compelling for investors to support you and help you grow. And this is a really big challenge that many of the organizations that we have in our network face. And so we set up a dedicated team several years ago, specifically to help social entrepreneurs navigate that challenge. And I'm sure that's probably going to be true for many of you as well. So I'm really happy to share a few insights into this, and then hopefully this will lead us on into the later coursework, which will come later on in this MOOC. So what I'm going to do is I'm going to speak for about 20 minutes, and please do feel free to ask questions in the chat as I go, and I'll do my best to try and make sure that we address them as we go. But there's going to be a lot of opportunity for interactive Q&A afterwards as well. So after I've made my short presentation, Adrian's going to have a dialogue with me, and we're going to try and pick up on some of the points that I'm going to raise. And then hopefully we'll be able to open this up to the group. So you'll be pleased to hear it's not going to be me talking for a whole hour. I think that would not be great. And instead, we're going to sort of just take you through a few basic concepts in social finance, and then see how that relates to your experience of raising capital, or how you're finding it. So what I'm going to do is share my screen and just show you a couple of slides. So Adrian, can you just let me know whether you can see my screen?
Yes, so it looks good.
Yeah, great. Okay, guys, so this is going to be about 20 minutes. And as I said, Adrian can read out some questions as we go, but I'll try and make this fairly quick. So as I mentioned, Ashoka is an organization that supports social entrepreneurs around the world. We support 3,500, just over 3,500 now. And we support them in every different sector. So healthcare, education, climate change, environment, you name it. There is an Ashoka project, an Ashoka fellow who's working in that area. And those projects cover the entire spectrum from non-profit to for-profit. Most of our fellows are actually non-profits, and I'll explain why in just a moment. But many, many of them are very, very interested in developing business models that will really complement them in fulfilling their social mission. And because of that, the ability to raise investment is particularly important for many of them. So before I continue, just to let you know, there's a resource that we've put up online called socialinvestmenttoolkit.com. And if you want, after this, you can go there, and we've put a lot of our case studies and materials up there, so you can see it for yourself later on at your leisure. So many of the ideas that I'm going to tease out here are actually expanded in much, much more depth on this website, and you can find the materials there. So before we begin, let's just start with a couple of quick definitions. And the most basic one is, what is social enterprise? So many different organizations have different ways of defining social enterprise, and it can be very, very confusing what it is that we're talking about, right? So for the purposes of this webinar today, let's define a social enterprise as an organization which uses a for-profit business model in order to achieve a social mission. Now, I know that many of you are actually nonprofits, and many of you are probably thinking about whether a for-profit business model would indeed be an appropriate way to raise funding or to support what you do. So we're going to come on to that in just a moment. But the reason why this is important is because a fundamental distinction in social finance is between philanthropy and investment. And essentially, the way of thinking about it is philanthropy is free money, in other words, grants, which is used to support a social sector organization in order to fulfill its mission, right? But there's a distinction between philanthropy, which doesn't require repayment, and investment, which does require repayment. So investment, if you're thinking about raising investment, essentially what you're doing is you're promising to the investor that you will repay that capital back at some point in future. Whether that's doing it as equity, which means selling shares in your business, or whether it is through a loan, which means that you're going to be repaying that capital. So a fundamental question for anyone who's thinking about raising finance is, are you raising grants because essentially what you're doing doesn't make profits itself? Or do you want to raise investment because you have the ability to repay the investor back in future? But you can only do that if you actually have a for-profit business model, because otherwise you don't have any surplus in order to be able to repay the investment. And so that decision has a fundamental consequence in terms of your ability to raise capital, depending on what kind of capital you've got. And so one of the distinctions is social businesses are businesses, and they seek to be profitable, but unlike a purely commercial business, not necessarily profit maximizing. And that's really, really important to think about, right? In other words, what a social business is doing is it's trying to maximize your social impact, however you define it, but not necessarily your profit. But you must make at least as much profit to cover the costs. Otherwise, the organization is not sustainable. And so social businesses are trying to do two things. They're trying to maximize impact, subject to at least covering your costs and being able to repay any investment that you raise. And that gives them certain characteristics that are a little bit different from a charity or indeed from a pure for-profit business. And that's why social business is actually a very strange kind of animal, right? It sits between charity and business. And therefore, it has the way it fundraises and raises investment and finances itself also is going to be a little bit different from both. And I'm going to just explain a little bit about what those differences are. So one of the ways that I try and think about this is that every social enterprise is really a combination of two different models, two different business models. There's what we might call your impact model, which is how do you actually create social impact? And there is what we might call your business model, which is how do you actually generate funds? How do you generate profit, right? And how do you pay for all this good work? And I've drawn them here as two circles, right? And I think that one of the first questions to ask is, what kind of social enterprise model do you actually have, right? And one of the ways of thinking about it is to think about the relationship between these two different circles, right? So in other words, is the way that you generate business and profits also the engine of your impact? Or are you one of those organizations which generates profits in order to give it to a charity which actually does the work, does the impact, right? And so we can come up with a different sort of categorization of different types of models. And the kind of model that you have will basically determine the kind of finance that you can raise. So let me just quickly draw a definition of social finance then. So as I mentioned, just as we had two circles that can describe your enterprise, creating impact and generating profits, we can also think of investors as having two motivations for investing in a social enterprise. One is social impact, and the other is financial return. And we can describe different types of finance based on the relationship between these two motivations. So, for example, somebody who only cares about impact and is not interested in having their money returned to them, essentially is going to make grants to an organization, and that's the role of philanthropy. Someone who only cares about financial return and is less focused on social impact, that's the conventional world of commercial finance. And then the very interesting piece is this point where these two circles overlap. And there's a circle, and this is what we call the area of social investment, right, or impact investing. And this is a subset of investors who care about both financial return as well as social impact, right? They want to see both. And that's the group that you're going to be appealing to if you're going to raise money for a social enterprise of any kind. So the question is, who are these enterprises? Who are these investors? How do we find them? And how do you speak the language in order to be able to really engage them, right? And so we're going to come on to that in just a moment, is who these people are and how do you engage them? Because they have this dual motivation, and therefore what they need to see is a dual offer, which is both impact and return. And then the balance between those two, whether they want more return or in exchange for impact, whether they want maximum return as well as maximum impact, that determines the kind of investor that we're talking about, right? And there's again a spectrum of investors. So the first question that any impact investor will ask you is, what is your business model? And if we go back to that description which I gave earlier around these two different ways of thinking about social enterprise, impact model combined with business model, then essentially I think at Ashoka what we see broadly three different categories of social enterprise, based on how these two circles interrelate. And those three categories I'm going to call the integrated model, the sponsorship model, and the hybrid model. And I want to just very quickly describe these three different types of models. And then I'm going to talk a little bit about how you fund each of these three different models. Okay, and then we can open up to a conversation and see. So integrated model, hybrid model, and sponsorship model. So let's start with the integrated model. This is actually the easiest one. And in this model, the two circles are essentially the same thing. So in other words, the way in which the enterprise funds itself and generates surplus is actually the same thing that it does when it's creating impact. And so an example of this would be a medical company that sells medical services or medical equipment, right? The more it sells, the more money it makes, but also the more impact it creates. And so there's really no distinction between an impact model and a business model. They're basically one and the same thing. And so if you are an organization that essentially has an integrated model, then in some ways your financing decision is actually much, much simpler than anyone else, right? Because essentially you are a business, you are a social business. And the better your business, the more profit you make, the more impact you will create. And therefore the natural way to finance that would be the way in which conventional businesses are financed, which is debt and equity. And we'll talk a bit about those functions, right? At the other end of the spectrum is the sponsorship model. And here, the circles are actually completely separate and distinct. So in this case, what's happening is that the way in which the enterprise creates impact is wholly different from the way in which it generates funds to fund that work. So essentially what we're talking about here is a charity combined with a business. And what the business does is it generates profit and then it uses those profits in order to fund the work of the charity. And again, this is a very, very common model for enterprises to adopt. It's one where essentially the business's sole function is to create money, and the charity's sole function is to deliver impact, and then one basically just sponsors the other, right? And there are benefits to this model, but there are also huge traps for any social entrepreneur who is thinking about this. So essentially, the biggest concern that I would have for anybody who puts forward a sponsorship model or is developing a sponsorship model is that essentially what you have to do is you have to have two different organizations. You have to have a business team that generates the profits, doing whatever sales they do, and then you have to have basically an impact team that is delivering the impact on the ground. And very, very rarely are these one and the same team. Because if they are the same team, it can be very distracting to be making sales whilst at the same time your real mission is giving education or working with refugees or whatever it might be that you're doing, right? So although it can be very tempting to set up a sponsorship model, it does carry a great deal of operational risk. And so the very best Ashoka fellows and the very best social entrepreneurs that we see, if you adopt a model like this, tend to find a way to integrate them in some very interesting or clever way. So even though they have two different teams doing two different sets of activities, they will find a way to link the two up in a way that adds value for both. So an example of this is a social enterprise from Belgium called Streetwise. And this is one of the best examples that I know about an organization that successfully operates a sponsorship model. And so let me just give you an example of what they do. So the charity is called Mobile School. And what Mobile School does is it works with street children around the world. I think they work with about 18 countries. And what they do is they take literally a mobile school. It's actually a van which goes into favelas and slums and areas where there are street children. And then when the van arrives, a teacher can get out and the van opens up and there are all kinds of lessons and games and visual aids that they can use in order to run lessons literally in the street for street children, right? It's a very, very powerful and effective charity doing great work. And it has no business model whatsoever behind it, right? These street children will not pay for this education, nor will anybody else pay for street children to be educated. So the classic way in which you would fund this is grants and donations. And indeed, that's what they've done for many, many years. However, the innovation that they came up with was to find a way to create a business that could actually generate profits that would support the great work of this charity. And the idea that they developed was to launch a business consultancy training program called Streetwise. And what Streetwise does is it runs really fantastic executive education for leading companies around the world. So they've had many wonderful clients like Nike, Barclays, many banks, many leading companies, many leading brands. And what they do is they train those executives in how to develop greater entrepreneurial skills. And the curriculum which they use is actually drawn from their work of working with street children. Because if you can survive on the streets, by definition, you're a great entrepreneur, right? And you develop all kinds of skills on survival, which can actually be learned and taught. And that's what they've done. And so the Streetwise consultancy not only teaches those skills, but they invite the executives to actually develop games and lessons that can then be taught in the street. And so it goes both ways. And many of their business clients will go on to sponsor and support and adopt many of these mobile schools because it's a great CSR project for them as well. And so here's an example of where a business, which is unrelated to the charity, generates income, but also builds awareness about the work of the charity, promotes marketing, and generates direct sponsors who will come and support the work. And so that's a very, very good example of how a business can support a charity with more than just funding. And then the final model that I want to talk about is what we might call the hybrid revenue model. And this is where you have an organization that it has a social mission. It also has business activities, and those business activities are actually also essential to the implementation of the social mission. But there are also activities that are never going to be commercial. And so the organization has to create a hybrid model where it has a combination of uncommercial activity and commercial activity. And so this might be a healthcare organization, for example, that wants to fight the problem of, wants to improve water and sanitation in rural villages around the world. And what they might do is that they might have a public health campaign where they educate people on how to sterilize water and make it safe for drinking. But they may also have a business which sells medicines and which sells water purification tablets, right? So both of these are actually essential for delivering their mission, which is to improve health outcomes. One of these activities generates income, which is the selling of medicine, and the other one does not, which is the education. And so what they have to come up with is a hybrid business which will combine both. And which will enable both to be funded. Now, the business by itself might be profitable, but when you have the business plus the social work, which does not generate, which is income, but which is pure cost, the combined costs of both renders the total organization either break even or less than profitable. And so the challenge for such an organization is, how do you fund yourself when you cannot do without one of those two things? You cannot ignore the business, nor can you ignore the social work that is being done, or the uncommercial work that's being done. And many of these organizations ultimately end up with what we call a dual legal structure, which means that they incorporate both a for-profit business and they incorporate a NGO. And what they do is that they have the activities of the commercial side in the for-profit business, and they raise investment for that for-profit business. And then they have the non-commercial activities, the purely social activities that generate no income. And they have that in the charity. And then they raise grants and donations into the charity, and they raise investment into the business. And so they have these two things working together side by side, but they don't confuse the different funding mechanisms because they actually have to fund them separately. And an example of that would be an organization in the UK called Fair Finance, whose CEO is a gentleman named Faisal Rahman. And I won't describe their business model in great detail, but essentially what happened was that about 10 years ago, they evolved from being a pure NGO raising grants and essentially doing two activities: making loans to indebted customers and giving debt advice for free to help them escape from their over-indebtedness. Into a business that would actually split itself, so that there could be a business that would make loans and a charity that would continue to give the debt advice. And that was basically how they were able to increase their amount of funding more than 10 times. And as a consequence of that, the business became profitable and now subsidizes all the work of the charity. So they've now become a break-even organization on the back of the fact that they were able to split themselves in this way and raise different types of finance on that basis. So that is a quick summary on three classic types of business models that we see social entrepreneurs adopting in order to be able to raise the different types of finance which they need to raise. And the reason why they have to adopt these different models is because when you're a social business or a social enterprise of any kind, it's very, very hard, right, to find the right kind of funder to support the work that you're doing. You know, the world of finance is not set up to fund mission-driven businesses. It's actually very schizophrenic, as I'm sure many of you will have already realized. People are very used to the idea of charities that raise grants and they don't make money. And they're used to the idea of businesses that maximize profit, and those businesses raise investment. So when you arrive and you say, well, I'm a business, but my mission is first and foremost to fight poverty or to solve climate change or any of these things. And I'm not here to make as much money as possible. I'm here to do as much good as possible. Suddenly, the world of finance is going to struggle, right? The people who make donations will go, okay, but it seems like you actually make money, so we're not sure whether we should give you a grant. And the investors will go, okay, you are a business, but you're not making as much profit as you could. And so it seems that your financial return is going to be less than what we typically expect. And so for those entrepreneurs who sit in the middle, and these are many of the clients of FASE, as Adrian mentioned, or indeed Ashoka, there is a very, very high risk that you will not be able to raise money from either organization. And so a lot of our work is really trying to help organizations to leap past this middle and solve this dilemma of you know, how do you do this? And one of the ways of doing it might be to create a business and a charity and raise money into both separately. Or it could be to find investors who are willing to invest in the organization, but who don't expect the kind of financial returns that a venture capitalist would expect, because frankly, that's not realistic. If you have a mission, and what you're doing is about working with refugees or working with street children or whatever it might be. So I'm going to stop there and really open it up for some questions, and perhaps Adrian might like to respond to what I've just said, or ask any questions on that, and we can take it from there. Thank you.
Thank you. I'm just going to read out, just to kick it off, one question from the audience someone wrote to me. I'm just going to read it out. What is your experience with countries where legal entity for social enterprise exists, and what do you recommend going for that? Yeah,
so in most countries, I'm going to just go back to this slide here. Actually, I'll leave it on there. So most countries don't offer good legal options for social entrepreneurs, right? So in most countries, you have to choose when you incorporate right at the beginning, whether you're going to be an NGO or whether you're going to be a business. And if you choose to be an NGO in most countries, then you can raise donations and grants. You probably have some tax benefits because you don't have to pay corporation tax. And indeed, you know, but you're also going to have a huge number of constraints put on you. And those constraints may be that you may not be able to raise any debt in some jurisdictions. And you almost certainly won't be able to issue any shares. So there's no share ownership, there's no equity option that's available to you. And so that is quite a problem. Particularly if you are a social business, if you actually have some kind of commercial activity which drives what you do, this is actually a very big problem, right? And indeed, even in some countries, you actually cannot even sell goods and services if you are a charity. So I think we would have to look at the Danube region and explore what makes sense for you. There are a couple of countries. The UK is one example. The US is now an example as well, where they have created hybrid legal structures which sit between a charity and a for-profit business. They have some of the tax advantages of being a charity, but at the same time, they have some of the options that you have from being a business, such as the ability to raise equity by issuing shares in your business. And different countries do this in different ways. So the UK does it by capping the dividends that can be paid by such legal hybrids, as well as having those entities regulated by a regulator who makes sure that they stay true to their social mission. So in the UK, that's called the CIC, or the Community Interest Company. In the US, they have an entity called the L3C, or the Low Profit Limited Liability Company. And that one is specifically designed as a company that can raise capital from foundations in the US on very, very favorable terms called program-related investment. So that one is very specifically designed for the US tax system. But in most countries, unfortunately, and Adrian, you can probably comment here a little bit more about Austria specifically, these options don't exist. And therefore, most people have to make this unfortunate choice between charity or for-profit business. And as I said, many entrepreneurs ultimately end up doing both, right? Which is very clumsy, but sometimes necessary if you want to have the benefits of both.
If I may jump into that, like just from my experience and working with the funding rounds of social entrepreneurs now for a few years, I would say, or my suggestion is always when I'm asked, okay, what should I go for as a legal form? I'm always telling them, well, in the beginning, you might be better off with having just a non-profit, because you can have foundation money, you can get maybe some state support for charitable entities. So that will help you in the beginning, but later, if you want to really scale, and I'm thinking about like really when you want to grow like within your country, or even like beyond your country borders, if you want to grow there and find investors for that, then having a non-profit entity that will kind of hinder you. And that's why I like your approach, Mark, saying, okay, at one stage, you actually, it makes sense to have both. To be honest, when I'm asked, I'm always having a look at the business model first, and actually, of course, at the problem. And then I would say mostly I tell the ventures actually to go for a for-profit entity, even though you will have more problems or struggling in the beginning, because you can't have foundation money, for example, going, or in some countries you can't have foundation money flowing into your entity. But when you then look for investors, you can give out a stake of your company, so you can have an equity round for your venture. And that, of course, when you have a growth case that also interesting to investors, that will help, because investors know that kind of spectrum better. They just know or most of them just know the for-profit world, and they struggle with hybrid or even just non-profit entities. But of course, one can't really generalize that. But when I see a case and it's more really a growth case, maybe the impact isn't that strong, let's put it like that, then I often recommend the for-profit. And when it's maybe more like a local, national approach to solving a problem, and the venture or the founder team is not really planning to really scale internationally, and then I also say, okay, maybe you're fine with the non-profit setup. Yeah. There was 2 questions in the chat. First one from Sabrina. How do you measure impact? I think probably that's how Ashoka measures impact. Maybe we can take that to the back, because I would say let's stay with finance now, then maybe we talk about impact measurement in the end if we have time, if that's fine for you, Sabrina. Then Alena is asking, what is the experience with venture capital financing for social businesses? Isn't it too risky that the business will be closed when the investor withdraws from the investment from the business later? Yeah. So I don't know if you want to answer that, or I should.
Sure, I can have a go, and then Adrian, please come in. The truth is this: we see venture capital very, very rarely in the social enterprise space. And the reason for that is because pure venture capital is designed for very early stage, but very, very high risk businesses, which social enterprises are. But the consequence of that is that they have phenomenal return expectations, right? So your average venture capitalist who's not a social investor, when they invest in a business of any kind, they will look to sell their investment in 5 to 7 years, and the minimum sort of amount of money they want to make is at least 10 to 15 times the original investment, right? 10 to 15 times would be the minimum. So you can imagine the extent of growth and profit that they're looking for, all right, in terms of that. And most of the social enterprises that we work with, at least, are nowhere close to that kind of. They're not going to become Google or Uber. That's not what they're about. And so we tend not to see social enterprises so much being funded directly by VCs. The exception to that is if the business of the social enterprise is already so commercial that essentially it does have the possibility to offer that kind of growth return as well as financial return. And there are a small handful of sectors where this is possible. So clean energy would be one example of that. I've also seen this in healthcare, technology. Essentially, these tend to be technology businesses and digital businesses, very scalable and potentially very, very profitable. So if you run something like that, which has a global potential, the demand's going to be huge, and the margin is significant on each product, then venture capital is a possibility, right? But this probably comprises less than 5% of the frankly, that's the social enterprises that are out there. Most social enterprises are not quite in that space. And
Yeah,
to be honest,
if I
please.
may jump in, the logic of venture capitalists and all, like having the multiples Mark just described, is also, okay, I invest maybe with my fund, I do 10 investments and 9 don't work out that well, and the one that I then invested, the last one, kind of is the new unicorn and goes to the stock market, and with that one trade I kind of make up for the other 9 investments. But this logic is, of course, not working in the impact, or mostly not working in the impact investment sphere, given that even when we have a social enterprise like really doing really well and growing rapidly, being like the new unicorn, that probability is rather low, and therefore we just don't see a lot of VC and also business angel money going in. Business angel maybe a little bit more, but the logic is like 1 to 9, which is normally applied. It doesn't work there.
Yeah, exactly. And so what normally happens in the social space is that we see early stage enterprises predominantly getting funded through grants initially. And so that's why they really pitch their social dimension to what they do. And then when they're raising capital of, let's say, between 50,000 up to €500,000, which is kind of like that very early stage, what we might call the seed round of investment, which is necessary to get you to the, to some degree of scale. The kind of people who fund that tend to be what we call impact investors. And this is a group of people who could be institutions, could be private individuals, could be foundations, could be government agencies, who are investing predominantly for impact and secondarily for financial return. So they do need to see their money back, but they don't necessarily need to see a 10 to 15 times return on that investment the same way a VC would, right? And so that's the group that most people on this call, I think, would be looking to speak to. Most of these impact investors, they come very clearly with a social dimension to their work. So they may be a private individual who is, says, I want to support climate change projects or education projects. And I'm willing to accept a much lower return because I want to see the impact that you create. Very often it could be a foundation that does this, where again, they already make grants, but now because you're inviting them to make an investment in you, they may be able to give more, or they may be able to invest more because investment carries a return with it. Or in the case of Austria, I suspect that there might even be social banks or regional banks or development banks that could provide loans on this basis. And Adrian, maybe you could comment on the kind of people who provide this early stage funding in the context of this region. But
I mean, I just already see it before going back to your question, Alena. I think your question directly at me at who the investors are was just answered by Mark, so that's good work there, even though not seeing the question. Before jumping to your question, Alex, I'm just going to elaborate on what Mark just said. Well, we like working with a lot of being from Austria and working in Germany, I can already see a difference there, and that can, of course, then in the Danube region is even more, even stronger, I would say. So in Germany, when we talk to investors, they tell us, okay, send me more financials. I want to see all the documents, and they are really hard on the due diligence process, on the process of screening your business. When I talk to Austrian investors, then they are like, okay, I like your 2-pager that you're sending me all the time, but why do you put your financials in there? I don't want to see them. I want to just see impact. So the approach in Austria is, of course, already a little bit more that they see impact investment as a kind of form of philanthropy and not of investment. Even in Germany, it's more the perspective, okay, impact investment is kind of, well, as a business angel, I approach it. I want to have my money back, and I want to do a little bit good. In Austria, it's already a bit more like, okay, I want to do good, and well, the financial performance is not that relevant. And that's also what I see in a few of the Danube region countries as well. So that the investors are more focused on the impact, at least the ones that are out there at the moment. But that's also my approach towards impact investment, nevertheless, is that always prepare the documents you have and you want to show the investors as if they would go on you really hard. So if they would like go and screen you like a venture capital fund would do. So have all the documents in a good quality at hand. And if in the end you find an investor supporting you who loves your mission and the problem you're addressing, then it's totally fine. And with that investor not want to see all those documents. But when you have an investor coming and he asks for documents and you don't have them ready, well, that's not the best case then. So always, I would say, always prepare for the worst and then hope for the best in finding like investors. And maybe I'm just jumping on Alexander. You were asking, you're working with schools and you want to scale now internationally, and you're asking whether you should set up as a I assume you are a non-profit at the moment, and whether you should go for profit. You can also, Alexander, if you can just turn on your voice and ask directly again if that maybe makes more sense.
Yeah, thanks. Yes, exactly. We are right now an association, and we don't have income at all at the moment. But obviously, if we want to sustain ourselves, we need to generate income, and this we can get from private schools, right? Not from public schools, but from private schools. So I wonder if it now already is like beneficial to incorporate a for-profit company, or yeah.
Yeah, maybe I can have a go at that one, Alexander. So the model that you've described is an absolutely classic situation that many social entrepreneurs are in. You have a product, you're selling to a customer base, but frankly, it's not a very lucrative customer base, right? You know, schools do not have big budgets, and they're not able to pay a great deal. And so it's probably going to be hard, even at the best of times, to fully cover your costs doing it on that way. And so what we've seen is, I mean, I've seen a number of different strategies for trying to solve this problem. And maybe I can just describe to you a couple of what those might be. So one of the ways that organizations address this issue is they split their funding into the commercial piece and the non-commercial piece. And so in this case, that might mean a commercial operation which sells to the private schools that can pay, and an NGO or a charitable operation which basically provides the product for free to those that cannot, or subsidizes those that have lower budgets, but then raises grants in order to be able to do that, right? And that might be a model. And if that was the case, then you probably would need to have these two entities from the beginning. You would need to have the commercial one, and you would need to have the nonprofit one. Most people start with the nonprofit because grants will normally be the easiest way of doing this at the beginning. Right? And then the question will be, to what extent do you see profitability from the private schools, and what can you charge at a price point that would generate enough surplus to begin to subsidize the work of the other costs, the ones that cannot pay. So and in terms of business strategy, what we see is two different types of model emerge. One is a cross-subsidy model, where essentially you have the same product and you just simply charge more for those who can afford it. Right, and so you essentially, you might brand them separately. You might have a different brand, but essentially it's the same thing, right? For those who can afford it, they pay more and they get a certain type of package, and those who can't, they pay less and they're subsidized by grants, but they get a different brand or whatever it might be. In other cases, as well as cross subsidy, there's also cross revenue, which basically means, is there a commercial product that you could sell which is related to your core product of the school curricula, the school format, but which could be monetized easier. Consultancy service, for example, teacher training service, for example, or something which is related to that work, but for which people would be able to pay extra or willing to pay extra. And if there is, then potentially you've got two revenue streams rather than one. you've now got a product stream from, let's say, training and consultancy, which is then used to support the work of rolling out the schools format that you have as your core social product, right? So sometimes, people solve this problem in different ways. Some people develop a range of commercial services which can supplement the social impact. Others do the cross-subsidy model where they price high for those who can afford and price lower for those who cannot. And in both cases, it might still make sense to talk about this split between grant funding and investment. But you have to be very clear what the grant funding is used for, and to make sure that it's not commercial, and then that the investment side is directed towards the business revenue streams, right? Because what you can't do is mix the two together. You can't raise donations into the same entity that also raises investment, because at that point you will have a conflict. The donors will go, wait a minute, I'm giving you this money for free, and you're paying this person, the investor, a financial return. This will not work. So being able to separate them out either legally or by activity is a key strategy to being able to maximize your ability to raise funding.
If Alex, did that answer your question?
Yes, it gave some insight. And actually, we do have that. You mentioned to have something that supplements our model that we can sell, and we actually are creating a software platform that helps our format. Okay. So we will look into that.
Great.
Okay, great.
Thank you.
Mark, I have to disagree with you because you just said, okay, that when you have a legal entity, that legal entity can't get donations from one side and investments from another side. I've seen a few cases. Of course, it's not daily or happening on a daily basis, but I've seen cases where actually you have that happening. Okay. The setup, of course, has to be that you are a non-profit, and then you can kind of get, of course, charitable money, and you can also receive kind of a loan which market rate returns like 2%, like really low loans, low interest on that loan. That's possible. It's not that it happens on a daily basis, but when you have, of course, you have the conflict of the donor giving money for free and the other one getting kind of a return for his or her investment. Yes. But if they're all committed to the impact in the end, then it can happen.
You're absolutely right. Sorry, that I should have clarified two things. One is typically the activity that you direct the loan towards might be different from the activity to which the grant is raised for. Yeah. So the grant could be raised for scholarships, for example, whereas the loan might be used to develop a new software platform. And so the purpose can often be different. It is an NGO that can do this. You're absolutely right. And there will have to be some restrictions so that you can't raise donations and use it to pay out the loan. So there will be ring fencing of the capital within the NGO to make sure that it is spent, not used to repay investors. But Adrian's absolutely right. It is possible with loans to do that. Yes.
And even it's an Ashoka fellow where I saw it.
Yes, that's right.
Yeah. Okay. Any more questions on otherwise I'm just gonna say some more about just experience with investors, if that's maybe relevant for you guys. Because the question I always get, okay, what is a typical, an impact investor? I'm giving out a loan to an impact investor, and what do they normally want to see as a return? And I would say we see everything in between 2 to 6% on that loan, on an annual basis. Of course, you can then add to that other kind of parts of a loan to make it more of a mezzanine financing instrument, you do an equity kicker, or you do in the end an impact target. So what happens a lot is actually that you have a subordinated loan, 5%, that's straightforward for 5 years. And then in the end, you set yourself an impact target, and you say, okay, when I reach that impact target, then I don't have to pay extra. But if I don't reach it, in the end, after those 5 years, then I have to pay a premium, like additional 5 or 10% once to the investor. So that's like a typical instrument we see a lot in European context, actually, at the moment.
Adrian, maybe I could just ask you a question, just based on your experience with this region in particular. One of the things, I mean, so enterprises can raise capital in 3 ways, right? Grants and donations, equity, or debt, loans. And I think which one they raise is actually as much a function of where they are based as what kind of business. So in the UK, for example, where I'm normally based, it's very much an equity culture. There is a lot of people who are very comfortable with buying shares, essentially, in social enterprises, and that would be the normal way in which you might raise funding. But I'm conscious that that's actually not true for large parts of Europe. And I'd be curious in your experience on the differences between availability of debt finance and the availability of equity finance for projects in this part of the world.
Yeah. Well, the question is always to ventures. You have to ask yourself, how am I kind of relevant to investors? Why would they invest in me? So what's the story? Is it an equity story, or is it a mezzanine story, or really just a loan story? So you really start from scratch and saying, okay, I'm just taking the example, you're Austrian LTD, so you're for profit. So you have the possibility to give out equity, and people invest in equity due to 2 reasons. Either they want to sell the stake of the company later to a higher price, which is the normal VC logic, or they stay long-term committed and want to get kind of dividends out of that. So those are the only two options why someone would go in with equity. But if you are a non-profit or set up as a non-profit, of course, that kind of option of the decision tree is already not available for you. So you have to look on the other side and say, okay, equity doesn't matter for me. I'm going to look at everything that has to do with loan and debt side. So then you look at that and say, okay, I'm that kind of case. I'm just relevant for investors because I'm a non-profit. No one will get an equity stake in that non-profit. So I focus. The only option for me actually is to give out loans or something related to that. So that's how you actually approach this kind of question. What kind of financial instrument do I use in the end? It's kind of, what kind of story am I to the investor? If I'm not an equity story, well, straightforward, then I'm kind of a mezzanine loan case. Of course, then you can dive a bit deeper and say, okay, what would I actually be able to pay? So you look at your cash flow in the next few years and say, okay, I would maybe be able to pay a 2% or 5% loan. And then with that in mind, you can start approaching investors. You should be clear about the story before going out to investors. And because when you approach investors and they say, okay, we just do equity, and you say, okay, well, I'm a non-profit, well, then this is already like too late. So you should already beforehand know, okay, we can't give out equity, and therefore we're just going to look at all kind of investors that just invest through mezzanine or loan structures.
And just to be clear here, when you're saying investors, for example, lenders, are you talking about Austrian banks, German banks, or who typically are the lenders in this case?
With mezzanine instrument or loan, or would you
with a loan? That's right.
Yeah, I would say we have some sustainable banks in Germany and also in Austria, and I think the whole Danube region. We have the Erste Bank. They have some good programs, but they are still kind of, I would say, reluctant to do direct investments. Sometimes it happens, but they often try to leverage other investors coming in by their instruments. I'm not an expert on Erste Bank's programs, but that's what maybe someone else is, but that's what I've gotten so far.
Okay.
But I would also say like this kind of loan structure is also relevant to will the foundations doing impact investment? Because a foundation, probably a charitable foundation, to be clear, they don't want to have equity stake in the company, because it's, for them, it doesn't make sense to have a huge portfolio, and they want to, maybe they are on a kind of committee to advise those ventures, and it's just a lot of work to have different equity stakes. They are fine with saying, okay, we want to do impact investment just via giving out loans. So that's one kind of actually large chunk. Then also some family office, I would say, who are not that business angel minded, but more charitable minded. They are also going for those loan structures. And then of some kind of, I would say, bank related players.
Great.
Yeah,
exactly.
Any more question on that? Or?
Yeah. How are we for time? Are we going to go an extra 10 minutes, or do we need to?
I don't know. I would say if there are questions. Now it's 3 o'clock. Thanks, first of all, to Mark for your input and your time. If there aren't any more questions, we can close it. If you want to us to continue, also a bit about maybe about the requirements of impact investors and stuff like that, we can do so.
Happy to do that.
Maybe we add another like 5 minutes, I would say, and then.
Sure.
Because there was one question sent to me. Where is it? Yeah, which priorities do investors have when choosing investees?
Okay, I think it really depends on the investor that you're speaking to, and essentially, I think you can segment investors depending on what stage of enterprise you're currently at. So we can talk about maybe 3 stages of enterprises. One would be in the very early stage, right, where you've just got going, you are expanding, and you are probably not break even yet. So you're still losing money every year. You still need to have investment coming in to support you during this time. And maybe you're looking to raise up to €500,000, but that's the kind of sort of capital size. If that's where you are right now, then essentially your sources of funding are going to be private individuals and foundations, right? It's unlikely that a bank is going to come in at such an early stage. They tend not to take that kind of risk. So essentially, you're going to need early stage impact investors, and these tend to be what we call angel investors. These tend to be private individuals in many cases, coming in with maybe 10,000, 20,000 euros each, and then a club of them could give you €250,000 of capital to be able to grow your business to the next stage. Those kind of investors tend to very much be very personal in how they look at things, right? There's not a lot of track record. So they can't do a lot of analysis on how much revenue you created in the past, because you haven't done a lot of revenue in the past. So for them, it'll be a lot around their belief in you as the management team, and your qualities as an entrepreneur, your understanding of the social problem, and your ability to articulate why your new business model is going to be the right one to solve that problem. So I would advocate for early stage investment, where you're speaking to private individuals and these angel investors. You really want to sell essentially your expertise, right? Your vision, and any kind of track record or validation that you've got up to that point to prove the hypothesis that your business model is based on. As your organization grows and becomes more advanced, usually the milestone is at the point at which you cross the break even. So if you have enough sales that you can actually cover your costs, you're out of that kind of desperation zone where you're sprinting for break even, and now you're looking for capital to grow, but you have some degree of track record. Then essentially that is what is going to be looked for. Investors will, at that point, and these now start to become banks, these now start to become larger institutions, impact funds, and so on. What they're looking for is, what is your track record and what is your evidence of actual impact created? So at this point, you need to have 2 to 3 years at least of actually measuring the impact that you have created for those schools, for those children, for those patients, for whoever it is that you're serving, and be able to actually argue quite convincingly for that impact, right? And then at the final stage, when you're actually quite mature and you're ready for significant scaling up, going from one country to another country, and you're raising 3 to 10 million euros, then it will basically be about the quality of the business model. And at that point, there'll be a lot of focus on your team, the track record, the quality of the operations, the quality of the customers, the quality of the distribution systems, and so on. And at that point, it will start to look a lot more like a conventional business that is being due diligence by a commercial investor at that point, right? So hopefully that's helpful. So those 3 stages are quite useful as a way of thinking about it. And, you know, early stage, it's about the quality of your insight and understanding. Middle stage, it's track record and impact. And late stage, I would suggest the robustness of your business model and the quality of the operations.
Thanks for that. I didn't know that differentiation in the phases. So I used a different approach, but thanks for that. Okay, guys, I think we're going to close it by that. And thanks again to Mark from Hong Kong joining us for that. And I hope you all guys participate in the MOOC. We are now in the 3rd week with the finance module. Next week, the management module is going to come online. So please follow us and our steps, because that will kind of help you to prepare for the next stage of the competition as well, where I hope all of you already applied to. If
Great.
not, I can post the link here again. Yeah. Thanks for Mark.
Thank you very much, everyone, and enjoy the rest of the MOOC series. Thank you.